Arguably known as the queen of growth investing, Cathie Wood from Ark Invest today came out and surprised me when she issued a warning about traditional growth stocks. Now, I don't want this to be a fear-mongering video because it isn't. In fact, this is a quote from Cathie Wood at a conference saying quite confidently that we are not in a bubble. So what's this news that's being spread around that Cathie Wood is not really excited for the future of these traditional growth stocks? Well, this all comes to something recent here where she implied that she might rather choose to own a government bond yielding near 1% over some of the US's largest market cap companies over the next decade. And this is a pretty vague statement to make claims off of, but let's do it anyways. Let's try to dissect what she could mean by this. You know, what maybe we can do in our portfolios to prepare for something like this if, you know, what her prediction is comes true. And really just take the time to understand this. So looking at her recent trades, we can see that Cathie Wood has been selling Facebook. She's been selling other large companies like Amazon. And if you look at her trades over the last few months, there's a few other sell orders on things like Apple and even Nvidia. These are all companies that are large cap companies. So what could this mean? Maybe this is what she was referring to. Maybe she means that these large businesses, these businesses that are, you know, close to $1 trillion in market cap, have limited upside versus the rest of the market and bonds, for example. Maybe she's implying that she believes that these companies for now have hit their peak performance and the yields from here on out it's probably not going to be that impressive. Over the last 1 year, big tech has done extremely well as a basket of stocks. Amazon here has been a bit of a laggard, but overall, gains from names like Google, Nvidia, and others have more than made up for the underperformance here. And typically, what do we see? When we see a stock or, you know, a group of stocks rally massively, outperform the market, provide us massive gains in such a short period of time, it's typically followed by a cooling period, a consolidation period, a period where the stocks go nowhere, or they correct, they move slightly lower, and maybe that's kind of what Cathie Wood is hinting at here. And just so you know, if you're new to the market, historically it's not been this easy to invest. You know, over the last year, you just pick one of these large cap companies, throw your money in, and for the most part, you've done really well, especially if you pick something like Microsoft or Nvidia. Those have performed incredibly well over the last year. So that was just a gift that the market gave us, and I hope that those of you that were part of that run realize that it's not going to be like this forever. So I mean, now let's think about this a little bit, right? So if Cathie Wood here predicts that these large companies that we just talked about, they're going to see, you know, flat negative returns over the next little while, where is all of that money from these stocks going to flow into? Where is the next opportunity really for these massive returns in relatively safe assets? The thing is, right now, we know that investors don't really have a whole lot of options to throw their cash into. Over the last year, by far, these large cap companies, stocks as a whole asset class, have been the best in terms of your risk to reward. You throw in some money, just wait a few months and you're typically up a good amount on that position because the broader market has just been going up and away. Sure, you could say that, you know, you could put your money into NFTs or cryptos, but the problem there is that those are extremely volatile assets. While there's opportunity to make a lot of money there, there's also opportunity to lose a lot of money there, and the risk to reward isn't as aligned as equities. So because of that, I don't think you're going to see, you know, large players in the market dump a significant amount of their net worth or, you know, their money or their assets into cryptos or NFTs. The other spot that people typically put their money in is, you know, international markets or bonds. Neither of those are doing well right now. Interest rates are low. International markets, they're just kind of chugging along. The US large cap companies is where everyone wants to be today. And that, you know, while may not be a bubble, signifies that there may be just a little bit too much optimism here and things will cool down sooner or later. The bottom line is, it's been a no-brainer in the last year to buy stocks, buy US stocks specifically, and focus on the large companies. But when I say buy stocks, guys, not all stocks have had a great 2021. The IWM here is an index that is comprised of smaller cap companies, and we can see that for the most part of 2021, it has been in consolidation range, essentially going nowhere since that sharp correction that we saw in late Feb, early March. During this time period, the S&P has pretty much just kept climbing, carried by the big tech companies here that we looked at earlier, and it only saw its second 5% correction in 2021 just this week. And if you study the market historically, history doesn't repeat itself, but it often rhymes, and that just means that after a big run like this, the market tends to cool off. And during this time, we see money start to rotate. Maybe it rotates within the S&P 500 to different assets in there. Maybe it rotates outside to different asset classes. There is typically money that's rotated as investors look for higher yield than what the broader market is providing. And I think this is kind of where it all comes together here with the S&P, especially versus small cap IWM type companies. I think, we may have already started to see it, but very soon, if not, we'll see a lot of money start to flow into these growth names. It's happening over a period of time. Growth companies have not had a good 2021 so far, but there's a lot of opportunity for these companies. I'm not saying go out there and throw your money into like some massively speculative growth name, because that's probably going to end up with losses. But I'm saying, good businesses that are just smaller companies have just not seen that attention from investors. And once money starts flowing out of these large mega companies like Apple or Facebook or Google or Microsoft, it's going to go somewhere. And right now it's looking like these mid cap and small cap companies where the opportunity is. And what we could see happen is we could finally see the S&P kind of flatten out here after such a big run this year. Maybe see a bit of a dip, but at the same time, if we see the IWM, the chart that we just looked at, if we see that break out and start making new highs, then at that point it's clear, it's confirmed money is rotating out of the large S&P companies and into these smaller growth companies. So at that point, that that's kind of where the future returns, for the foreseeable future at least, is going to be. So I think this is kind of what Cathie Wood meant by these large cap companies not being the best investment vehicles going forward. And based on what she's been buying recently, it's clear that she believes that growth names in the small or mid-cap space is where you need to put your money. I don't think she literally meant that buying government bonds is a better option here. I think what she meant to say was that, even a government bond which is yielding next to nothing will do better than these large companies. In other words, these large companies are probably going to underperform in the next few years, possibly the next decade. But again, huge disclaimer, this is all speculation. This is just my understanding of this statement. I thought about it, tried to dissect it, and I figured it'd be a good video to share with you guys. Personally, if we do see a sizable dip in the market, I'm not talking 5%, I'm talking more like 10, 20%, despite what Cathie Wood's saying here, I would probably deploy a lot more cash into these large cap companies. Again, yes, they have run up a lot. Yes, they do need a cool down. But I still think there's some steam left here, and these companies are still expected to have a good 2022, 2023 even. So I don't think the party is completely over yet. We may be getting to the end of the party. Cathie Wood may just be a bit early here. But again, all speculation, just my thoughts. Now guys, I'd love to hear in the comments down below, do you agree with Cathie Wood? Do you think it's time to start buying these growth stocks, these small cap stocks, these mid cap stocks, and kind of shying away from these large big tech companies, use that capital for these smaller businesses and just kind of enjoy the gains that way? Let me know if that's the mentality you think we should be going with, or if there's something else you want to share in the comments below. Anyways guys, thank you so much for watching. Don't forget to invest positively, and I'll see you in the next one. Peace.